Welcome back to the show, everyone. We have Laura again from Lighthouse Financials. Oh my God, I got the name right this time. Laura, I assume all of your clients have never made any mistakes when it comes to borrowing money from the banks.
Never.
Never. All right, so I guess there's no point in talking about any mistakes.
No, I wish that was the case, but
Tell us.
it's not always, but that's why we're here to help. I would say the most common ones that we see is people think that it's something they can do on their own.
And they do?
Yeah, they do. And that's fine. Some people do it on their own and they get it right. But a lot of people do it on their own and they don't get it right. And we've spoken about this before. Like, you should be running your investment portfolio like a business. And you probably wouldn't go up and start a new business from scratch and get no kind of professional advice or guidance. So
lots of people do.
Yeah, yes, and again, but does that go well? Not all the time. And I would say also owning your own home is quite different to owning an investment portfolio. So again, it's there's things that we would know as professionals that you might not be aware of because you've never been in that investment space. So definitely talking to mortgage advisors, financial advisors, accountants, kind of getting all of that knowledge and know-how and structuring everything properly. It shouldn't be a cost-cutting exercise. You shouldn't be like, well, I have to pay an accountant for this, so I'm not going to bother, because that can actually end up making you money rather than costing you money.
Okay.
The main thing that I think we see is this misconception about raising your deposit for the investment, or thinking that you can just borrow a whole heap of money to go and renovate the property. We've spoken about this before, the deposit requirements of 30% for investments and being able to leverage on your existing properties to get them deposits. If you're buying a property that needs a lot of work doing to it, you need to borrow that money from your existing properties as well. Very rarely the bank is going to lend money on the house that you're buying for you to be able to renovate it, because essentially they're relying on the future value of that property.
I understand.
They're lending money on something that isn't worth what we're saying it's worth in its current state. So you're needing to use the equity that you've got in your existing portfolio. And a lot of people kind of just think, well, I've got the money there available for the deposit, so I'll just add on the renovation cost as well. That doesn't always work. So we need to make sure that there's sufficient funds available for the whole project. Not having the right structure, or quite often we see people are borrowing the deposit funds secured against their house and then kind of just leaving that debt secured against the house, and not realising that because that money was borrowed for the purpose of investment.
As deposit for the next investment.
Yeah, as a deposit for the investment. Although you borrowed that against your home, it was for the purpose of buying an investment property, and therefore there's actually interest deductibility available on that lending because you've used it for investment purposes. So again, engaging with an accountant.
But isn't it an accounting's job to do that?
Yeah, but that's
allocate.
Exactly. But a lot of people, because they don't realise that's something you can do, and they're not working with accountants, they're missing out on this element of interest deductibility. And again, we've spoken before about making sure that you've got as little debt as possible secured against your house and more secured against your investment property. So
a lot of people, for whatever reason, historically have got that upside down. They've got more debt loaded up against their home.
And I think that's just because in theory you can borrow more against your home. You can borrow 80% of the value of your home versus 70% of an investment, which is great for being able to get those deposits. But once you then own those 2 or 3 properties, then reevaluate and look at, okay, how do we reallocate this debt to the investments more than my home, and
how do we
restructure it?
Reallocate those? Is there anything you can do to reallocate the debts?
From a lending perspective, if you have both of the properties or all 3 properties at the same bank, the bank is essentially taking security across the combined value of 3 properties and the combined value of all of the debt. So a lot of people have this idea in their head, well, when I bought the investment, I borrowed 500,000 to buy that house, so I only owe 500 against that house. You don't. You owe 500 on top of everything else that you own for all 3 properties. So they take the combined value of the houses and the combined value of the debt, and it's across all of the securities. It's not, very, very rarely is it split out per property. For tax purposes, you can allocate it per property, but generally speaking, from a lending perspective, it's all kind of cross-securitized.
And in that case, we could look at opportunity to split banking then.
Split banking is quite an effective way of doing that. Again, you can borrow up to 70% of the value of the property. So if you are buying a house and you're planning on doing renovations to it, once that property has been renovated, get it revalued, and then that increases the amount of debt that you can secure against that property because the value's gone up.
Cool. And I think the other thing is a lot of people, when they negotiate with the bank directly, they may not get the best advice from an independent third party like a mortgage broker like yourself, and they will do things like fixing the rates for 4.99 in the current market.
We see this quite a lot of times with investors, and because their intention is to hold the investment property for a long period of time, they think that the fixed term needs to reflect that. So we see people fixing for 3, 4, 5 years. not a good idea in this kind of market where interest rates are finally coming down. If interest rates were going up and up and up, then yes, like, you know, fixing for those longer periods of time makes sense. But it's all about kind of tracking the market. Just because you're intending to hold this property for 5 years and you've got it on 5 years interest only doesn't mean you need to be fixing a 5-year interest rate. So yeah, definitely kind of having those conversations with advisors and looking at the longer term plan and how that kind of corresponds with the changes in the markets as well.
Cool. So basically, to avoid all of those mistakes, all you need to do is to contact Laura from Lighthouse Financial.
Yeah.
Thank you.
Thanks.